Hey, it's Wayne from Visionary Wealth Management, and it's time for a bit of an update on the economy and what we're thinking about here. And we are a little concerned. So we've gotten a bit of a bump back in the stock market. We're getting some volatility. I happen to be shooting this video on a day that's a pretty good down day for the market. There's a lot of things going on that are actually concerning me. So it is absolutely true that inflation is going to come down. Now, part of the reason inflation is coming down is because inflation was rising so fast this time last year that the year-over-year comparisons make it look like it's slowing down. But if you go back 2 years or 3 years, inflation is going to continue to be with us, specifically in the labor costs. So there are demographic movements here that are going to continue to push up the cost of labor, and I'm very concerned about the fact that as labor costs continue to rise, but overall inflation rates come down, companies won't have pricing power, and then so the labor costs are going to become a larger pressure, a bigger pressure on corporate earnings over the course of the next 6 to 18 months. We've got a number of other things as we move into the winter that we're concerned about. We're concerned about European energy prices. We're concerned about interest rates. There is a very high percentage of the corporate bond market that has moved into floating rate debt over the course of the last 2 to 4 years. And as that has happened, there's a lot of that debt that is going to be adjusting its interest rate, because floating rate debt interest rates float with the market. So as interest rates go up, the debt payment, the interest payments on that debt go up. And so the companies that are issuing that debt have larger liabilities, larger cost for their interest payments. So we're very concerned about what that does to corporate profits. We're concerned about geopolitics. This gets into Russia, Ukraine, it gets into China and the South China Sea, and 100 other variables around the world. There's a lot of pressure and a lot of things that could go the wrong way over the course of the next 6 to 18 months. And then the primary canary in the coal mine that we always look at is bond default rates. Bond defaults are rising. And so remember, if you loan me money, then I have a bond. I owe you capital. So if I default on that bond, you actually have an asset on your balance sheet. So it was a liability on my balance sheet, but that loan was an asset on your balance sheet. So when I default, you actually lose capital on your balance sheet. And so as those dominoes start to fall, so one company defaults, another company has assets that evaporate off their balance sheet, and then that puts their bonds at risk of defaulting, and then another domino and another domino. That's a slow motion domino falling process that plays out over many quarters. And so we think that there's significant risk for some of those dominoes falling more quickly over the next 6 to 18 months. And so we're not calling for significant upswing in the stock market here. We could be in for a bit of a longer slog and more than one negative year in a row. So we're preparing for that. We're looking to work with large, well-protected businesses with wide moats, relatively low debt loads. We want to be protecting your cash flow. If you're retired or close to retirement, we want to be making sure that we're protecting at least 3 to 5 years worth of your cash flow at all times. Periods like this, we're probably going to protect a little bit more. So if you have questions on this, or somebody you know is concerned about what they're doing, please feel free to forward this to them. We're happy to have a no obligation conversation to help them think through these things appropriately as well. But here at Visionary Wealth Management, we're always here with perspective for the decisions ahead, even when we see some storm clouds on the horizon that we're a little concerned about. Call us anytime. You're never an inconvenience. Take care.